The tariffs announced by the Trump administration and the response by Canada and other countries is being felt in the commodities space. Joining us with more is Bart Melek, Global Head of Commodity Strategy with TD Securities. Bart, always great to have you on the program. Here we are. We've talked about it heading into it. We're in a tariff environment. What's going on with gold in the face of all this?
Well, it's wonderful to be back. Well, gold has done very, very well, and in great part because of tariffs. Many investors have try to source gold ahead of the tariffs, and clearly a 25% tariff means that the U.S. gold price will be higher. So we've seen large inflows of metal from London market in particular into the U.S. market, delivered into COMEX against COMEX futures. So we've seen large spreads in price, as much as $50 at the peak of it, between London price and the U.S. COMEX futures prices. And essentially, you know, many investors are worried that we might see inflation coming up. In fact, central banks are worried we might see inflation from the tariffs as well, and the much more restrictive migration policy that might reduce supply of cheap labor for certain sectors. So a combination of beating the tariffs and using gold as a hedge has propelled gold to new record levels. Not quite 3,000, but very, very, very close. And I think for now we might see some consolidation a little lower as the momentum slows down, but we still fundamentally think gold does very well down the road.
Even apart from the tariff story, the conversations you and I have had for quite some time is that we're seeing central bank buying as well, and that was sort of America-related story as well.
Yeah, central banks have been buying at a record clip in 2024, well over 1,000 tons. Not quite an all-time record, but very close. And we've had, you know, a few consecutive years of that behavior. So central banks are, of course, worried about you know, the U.S. dollar, its purchasing power, given sustainability of purchasing power, given the fact that we could see very large deficits, possible interference in the Fed from the Trump administration. So that aside, there's a geopolitical factor to it where as the relationship is becoming a bit more turbulent between, let's say, China and the United States.
Do you want to hold U.S. dollars or do you want to hold gold? Right?
And there's been a definite move towards gold, and China has been on the forefront of those record numbers. You know, they look at Russia, see what happened to them with the sanctions, where half of the reserves were rendered useless, but the gold bits were still, you know, very effective in securing financing and making deals. So I think as that situation and tensions rise, and who knows, maybe in the South China Sea as well, I think China and many other non-aligned countries will want to buy gold to protect against potential erosion of purchasing power, but also to protect their asset from sanctions.
All right, that's a story for gold. We have oil as well. A different tale here. What's going on in the oil market?
Well, right now the oil market is a little weaker than it was. If we see tariffs, you know, stick around for a while, they're not 25% like all other goods from Canada and Mexico. It's 10%. Basically, the price of oil in the United States will be higher than it would have been otherwise. Doesn't necessarily mean it's going to be higher, because we've seen some news from OPEC that they might release more supply come April. We're seeing large production increases around the world, as much as 1.4 million barrels, and demand continues to be quite weak, particularly from China. But, you know, for any level of prices, tariffs make them a little higher. We, in fact, you know, have noticed that the spreads, the difference between Western Canadian Select, the Canadian stuff, that goes to refineries in the U.S., and WTI, the light crude, has actually shrunk. And, you know, in spite of the tariff talk, so things got a little better, and that was, you know, mainly because the administration in the U.S. has targeted Venezuelan crude, which is not going to be as available as it was. So there are a lot of moving parts, but generally speaking, tariffs mean higher prices than they would be otherwise, and it also likely means that the importing country pays vast majority of that cost, because the demand for energy is pretty price inelastic, meaning it doesn't really change very much. Even if prices go up or down, you kind of use what you're going to use, at least in the short run to medium run.
The scenario you laid out there sounds like the U.S. needs our Canadian oil. We get mixed messages from our largest trading partners as to whether they need it or not. What's that situation there?
Well, we wrote a paper and looked at this a while back. Yes, they absolutely need it. About 4.2 or so million barrels of Canadian crude goes to the United States, and it goes there not because they don't need it, it's because they do need it. At this point, bulk of the refining capacity is tooled, particularly Midwest and in Texas and such, for the heavy. The heavy has certain properties where certain distillates, the heavier ones like diesel and so, are more prevalent. And if you don't have it, if you try to retool and use just the light, you don't have those products that you need, and I don't know how you source those. So you can maybe displace some of the Canadian heavy with Iraqi heavy, or somewhere in the Middle East, maybe Saudi. But the problem is, for refiners in the U.S., it's going to be much, much more expensive than the Canadian stuff. As we said, the Western Canadian Select trades at a discount to WTI, while the other brands may be trading at a significant premium. Because remember, we have a very cheap way of getting it. It's called a pipeline. And if you had to have that product go somewhere else, come from somewhere else, you'd have to pay for, to onboard it. You'd have to ship it inland by some way. Maybe you'd have to build pipelines, rail. We're not quite sure how that would go. There is a possibility that as much as 1 million barrels could come from the Middle East. It'd be more expensive oil, and from talking to refiners, they don't really would like to do that. But in Canada, we have maybe 300,000 barrels plus going to California through the pipeline, that can go to the Pacific. So on a net basis, maybe at the worst case scenario, 500,000 barrels get impacted.